Stephen, big difference in the way this market's trading. So let's sit on that just for a moment. We've talked about it through this morning. The physical market's doing one thing. Walk us through what's happening there relative to how we're pricing things in the paper market over the last week.
Yeah, absolutely. So first and foremost, of course, we're concerned about Hurricane Francine making landfall today along the Gulf Coast, the refinery epicenter. So we are seeing some reactions into the market on this event. Now, assuming we come through the event unscathed, what we're looking at now is a physical market that appears to be relatively tight here in the United States. So, for instance, the Cushing, Oklahoma terminal complex, where you make and take delivery on the futures contract on the paper market, physical barrels there have fallen in 15 of the last 16 weeks, 11 weeks in a row. The decline of over 18 million barrels is about 40% above seasonally adjusted norms. So we're seeing a significant drawdown in the physical market, and this is being reflected in the paper market in the spreads. When we look at the differential over given time periods, that we're looking at a clear premium being paid in the spot market, which is a clear indication that the paper market is telling us the physical market is way too tight and therefore not enough supply as we go into the fall turnaround season.
Just taking a step back, Stephen, are you basically saying that the decline that we've seen in the contracts around oil just simply at this point is a head fake, and that you're going to see some sort of price spike as people realize the physical dynamics at play?
Well, it's a good question, and a massive driver of the price declines we've seen over the past 2 weeks has been an incredible amount of futures contracts in both the NYMEX, New York Mercantile Exchange's WTI contract, and the ICE Brent crude oil contract, where we've seen a number of speculative shorts, mainly hedge funds, come in selling a heck of a lot of oil over the past 2 weeks. And we've also seen a lot of selling by the bullish funds, i.e. they're getting stopped out. So therefore, we have bearish hedge funds that are establishing new shorts, and that selling has been exacerbated by panicked bulls trying to cover and get out of their positions. So what we're seeing now is a bit of a squeeze in the market. I do think we are overdone. Keep in mind, I think essentially, yes, to answer your question, this is most likely a head fake. We are going into September, October, the weakest demand months of the year, but we are setting up the form of base now over the next few weeks that will set the foundation for a rise when demand begins to pick up in the latter part of the fourth quarter.